Okay, let's unpack this. We're diving into the recent earnings and outlook for HP Enterprise, HPE.
Right.
We've looked at news reports, the official release,
Yep.
quite a few sources.
Mm-hmm.
The goal here, really just to quickly get you up to speed on how HPE did last quarter, what they're expecting, and maybe what that tells us.
And yeah, the first thing grabbing headlines was pretty positive. HPE shares went up after hours.
Oh, okay.
Their Q2 results beat what analysts were expecting. Handily beat them, actually.
Nice pop from the market then. So let's get into those Q2 numbers.
Yep.
This is for the period ending April 30th.
Right?
HPD reported adjusted earnings, $0.38 per share. Analysts were looking for $0.33, so a solid beat there.
Absolutely strong on the bottom line. And revenue looked pretty robust, too.
How robust?
They brought in $7.63 billion. That's up almost 6%, 5.9% year over year.
Okay.
And analysts were thinking more like $7.45 billion. So yeah, beats on both top and bottom lines.
Impressive. Especially, when CEO Antonio Neri mentioned operating in a, quote, dynamic macro environment, he highlighted solid performance, saying revenue grew year over year in each product segment.
And digging into those segments is really key here, I think. Server revenue, that's their biggest piece, saw a 6% rise year over year, came in at $4.1 billion. And this definitely got a boost from AI spending. That's a huge tailwind right now.
That AI connection is critical, driving volume for sure. But I noticed looking at the server segment margins, they were down quite a bit.
Yeah, that's right.
From 11% last year to just 5.9% this quarter. What's causing that pressure, even with the AI demand?
Well, it's an interesting point. The CFO did say margins got better as the quarter went on, which suggests maybe some costs normalized.
Maybe.
But the overall drop could be higher component costs, maybe pricing pressure in the server market. It's competitive.
Or the server mix itself.
Exactly. Maybe these high-demand AI servers just have lower margins initially while they ramp up. It's definitely something to keep an eye on. Is it temporary or more structural?
Okay. So moving beyond servers, how do the other main parts of the business do?
Intelligent Edge did well. Revenue up 7%, hit $1.2 billion.
Okay, strong.
Hybrid Cloud was also quite strong. Revenue up 13% to $1.5 billion.
Nice growth there, too.
Yeah, the only segment really that dipped slightly was financial services, down about 1.3% to $856 million. So good growth across the main product areas, really.
So with that solid Q2 behind them, what did they say about the next few quarters? Let's start with Q3, the current one.
Okay, so for Q3 fiscal 25, they're guiding to adjusted earnings per share between $0.40 and 45 cents.
And the midpoint there?
204.25 cents, which is actually a little bit above the consensus estimate of $0.41.
Okay, slightly ahead of expectations. And Q3 revenue?
They're forecasting between $8.2 billion and $8.5 billion. Again, the midpoint there is higher than the $8.22 billion consensus. Looks positive for the immediate term.
All right, and zooming out to the full fiscal year, 2025, any changes to the big picture?
Yeah, a slight tweak. They adjusted their full-year guidance, specifically raising the low end of their adjusted EPS range.
Okay.
It's now $1.78 to $1.90. It was $1.70 to $1.09 before.
And analysts were around $1.80.
Exactly, $1.80. So the new range brackets that number.
What does raising just the low end tell us? What's the signal there?
Well, lifting the floor suggests they're more confident about hitting at least a certain baseline profit level for the year.
Okay, makes sense. More certainty.
Right. Better visibility on operations, demand maybe, but keeping the top end the same. And they actually narrowed the revenue growth range a bit.
Oh.
Yeah, to 7% to 9%. It was 7% to 11%. So that might signal they still see, potential challenges, macro headwinds, or just execution limits capping the absolute upside.
So confidence, but maybe cautious confidence.
Something like that. Shows they feel good, but maybe not like everything's completely clear sailing ahead.
That nuance seems important. We saw one analyst note that while HPE might not, fly like some pure AI stocks,
right,
these solid results across the board and the positive outlook suggest maybe the stock found its footing back in April.
Yeah, I think that sums it up pretty well. The underlying demand, especially AI servers, Intelligent Edge, it's clearly there in the numbers.
So wrapping this up, what does it all mean for you? We saw a pretty solid growth in key areas. Server, Intelligent Edge, Hybrid Cloud. Servers definitely got that AI spending boost. HPE beat estimates last quarter, and they nudged up their full-year earnings floor, signaling more confidence.
But we also noted that margin pressure in servers and the slightly more cautious full-year revenue range.
Exactly. Which brings up an interesting point for you to consider. The results look strong, Management seems disciplined, but the stock had been underperforming this year before this report.
Right.
So thinking about these strong results and the positive outlook against that backdrop, what does this contrast tell you about how the market weighs different things right now? Like, how does it balance, say, AI excitement versus broader profitability and execution across a whole company? Something to think about.